Look, I need to tell you something that's going to sound crazy at first, but stick with me, because what I'm about to show you is backed by thousands of years of history and what's happening right now in the financial system. Your money sitting in a bank account? It's not actually safe. I know that sounds insane. We've been conditioned our entire lives to believe banks are the safest place for our wealth. But here's what they don't tell you. Your money in the bank isn't really yours anymore. The moment you deposit it, it becomes the bank's asset and your liability. You're an unsecured creditor, and in a crisis, you're last in line. Let me paint you a picture of what's really happening right now. In March of last year, we watched Silicon Valley Bank collapse in 48 hours. 48 hours. One of the largest bank failures in American history. And it wasn't some reckless gambling operation. It was a bank that held treasury bonds, the safest assets in the world, supposedly. But when interest rates rose, those bonds lost value, depositors panicked, and the whole thing imploded before regulators could even react. Now here's the part that should terrify you. SVB wasn't alone. First Republic Bank went down. Signature Bank collapsed. Credit Suisse, a 167-year-old institution, had to be absorbed by UBS in an emergency weekend deal. These weren't fringe players. These were pillars of the global financial system. And what did the government do? They stepped in and guaranteed deposits above the FDIC limit. Which sounds great until you realize what that actually means. It means they printed money. They expanded the money supply to cover those deposits. And when you expand the money supply, you devalue every dollar in existence, including yours. So your money was safe in the sense that you got it back. But the purchasing power of that money? That's a different story entirely. Here's what's really happening behind the scenes. Central banks around the world are buying gold at a pace we haven't seen in over 50 years. The World Gold Council reported that central banks purchased over 1,000 tons of gold last year. 1,000 tons. That's not a hedge. That's not diversification. That's preparation. China's central bank has been buying gold for 17 consecutive months. Poland just moved 100 tons of gold from the Bank of England back to Warsaw. Why? Because they don't trust the system anymore. They're repatriating their wealth, getting it out of the banking system and into physical assets they can control. Turkey's central bank has increased its gold reserves by over 300 tons in the last 2 years. India is accumulating. Singapore is accumulating. Even countries that have historically held minimal gold are suddenly buying. These are the people who have access to information you and I will never see. They're making moves based on what they know is coming. And it's not just central banks. The ultra-wealthy are doing the same thing. Ray Dalio has been vocal about holding gold. Stanley Druckenmiller increased his gold position significantly. These are people who have made billions reading market cycles. They're not buying gold because they think it's going to go up 10%. They're buying it because they believe the entire monetary system is at risk. Now let me show you why they're right. The United States has $34 trillion in debt. Trillion. With a T. That number is so large it's almost meaningless to the human brain. But here's how to think about it. We're adding $1 trillion in debt every 100 days now. Every 100 days. And here's the kicker. We can't afford the interest payments anymore. The interest on our national debt is now over $1 trillion per year. That's more than we spend on defense. More than we spend on Medicare. We're borrowing money just to pay the interest on the money we already borrowed. That's not a sustainable system. That's a death spiral. So, what happens when you can't pay your debts? You have two options. You default, which destroys your credibility and crashes the system. Or you print money to pay them, which destroys the currency and crashes the system differently. Either way, the outcome is the same. The value of your dollars goes down. And this isn't theoretical. We've seen this play out dozens of times throughout history. Weimar Germany, Zimbabwe, Venezuela, Argentina, Turkey, Lebanon. Every single time a government prints money to solve its debt problem, the currency collapses and the people holding that currency lose everything. But here's what's different this time. The dollar is the world's reserve currency. When the dollar loses value, it doesn't just affect Americans. It affects the entire global financial system. And that's exactly what we're starting to see. The BRICS nations, Brazil, Russia, India, China, South Africa, are actively working to create an alternative to the dollar. They're settling trade in their own currencies. They're building payment systems that bypass SWIFT. Saudi Arabia is now accepting yuan for oil sales. That's massive. The petrodollar system has been the foundation of American financial dominance for 50 years, and it's cracking. Here's a story that illustrates what's really happening. In 2011, Muammar Gaddafi proposed creating a gold-backed African currency to replace the dollar for oil transactions. 6 months later, NATO intervened in Libya, and Gaddafi was dead. Coincidence? Maybe. But it sends a message about how seriously the establishment takes threats to dollar dominance. Now we're seeing entire nations making that same move, and there's nothing the US can do about it. China is too big. Russia has nuclear weapons. Saudi Arabia has the oil. The world is de-dollarizing, and when that process accelerates, the value of your dollars is going to plummet. So where does that leave you? Sitting on cash in a bank account that pays you maybe 4% interest while inflation runs at 7 or 8% real terms? You're losing purchasing power every single day. Your savings are being quietly confiscated through monetary debasement. And here's the thing about banks that nobody talks about. They don't actually have your money. They have a fraction of it. It's called fractional reserve banking. For every dollar you deposit, they're required to keep maybe 10 cents on hand. The rest, they lend out. So if everyone tried to withdraw their money at once, the bank would collapse. That's not a conspiracy theory. That's how the system works by design. We saw this in the Great Depression. Bank runs destroyed thousands of institutions. People lost their life savings overnight, and the FDIC was created to prevent that from happening again. But here's the problem. The FDIC has about $120 billion in its insurance fund. Total deposits in U.S. banks? Over $18 trillion. If multiple large banks fail simultaneously, the FDIC doesn't have nearly enough to cover it. They'd have to go to the Treasury, which would have to print more money, which brings us right back to currency debasement. You're starting to see the problem, right? The entire system is built on confidence. As long as everyone believes their money is safe, it is safe. But the moment that confidence cracks, the whole thing unravels incredibly fast. And right now, that confidence is eroding. Quick aside here, because this is important. If you're sitting on $100,000 or more in retirement accounts, I put together a free guide on how gold IRAs work. It's in the description below. It covers how to get physical gold into your retirement account without tax penalties, how the process works, what the costs are. Worth checking out if you're thinking about protecting your retirement savings. No pressure, just information. Anyway, back to what's happening in the markets right now. Gold just broke through its all-time high. Again. For the 6th time this year. And it's not because of jewelry demand or industrial use. It's because smart money is fleeing the banking system and moving into hard assets. Silver is even more interesting. The gold-to-silver ratio is sitting around 85-1 right now. Historically, that ratio averages around 60-1, which means silver is massively undervalued relative to gold. But here's the real story with silver. It's not just a monetary metal anymore. It's an industrial metal that's critical for solar panels, electric vehicles, electronics, and green energy infrastructure. We're using more silver than we're mining, every single year. The above-ground stockpiles are being depleted. And unlike gold, which mostly just sits in vaults, silver gets consumed. It's used in manufacturing, and it's gone. That creates a supply deficit that's only going to get worse as the green energy transition accelerates. So you have monetary demand increasing because people are losing faith in currencies. And you have industrial demand increasing because of technological trends. That's a perfect storm for price appreciation. But here's what most people miss. The price you see quoted for gold and silver? That's the paper price. That's the price of futures contracts and ETFs and derivatives. It's not the price of physical metal. And there's a massive disconnect forming between paper and physical markets. The COMEX, where gold and silver futures trade, has about 500 ounces of paper claims for every 1 ounce of physical gold in their vaults. 500-1. That's not a market. That's a Ponzi scheme. And when people start demanding physical delivery instead of cash settlement, that whole structure is going to collapse. We're already seeing signs of stress. Premiums on physical gold and silver coins are elevated. Delivery times are extending. Dealers are running low on inventory. The U.S. Mint has had to ration Silver Eagles multiple times because they can't keep up with demand. These are warning signs that the physical market is tightening while the paper market pretends everything is fine. Let me tell you about what happened in 1971. Nixon closed the gold window. He ended the convertibility of dollars into gold because foreign governments were draining Fort Knox. France sent a warship to New York to pick up their gold. They didn't trust the dollar anymore. And Nixon had a choice: let the gold leave and admit the dollar was overvalued, or end the gold standard entirely. He chose the latter. And what happened next? Gold went from $35 an ounce to $850 an ounce by 1980, a 2,400% increase in 9 years. People who held gold preserved their wealth. People who held dollars watched their purchasing power evaporate. We're in a similar moment right now. The difference is, this time there's no gold standard to abandon. We're already in a pure fiat system. So when confidence breaks, there's no backstop, no anchor. Just unlimited money printing and currency debasement. And here's the scary part. Most people have no idea this is happening. They're going about their daily lives, trusting that their bank account is safe, trusting that their dollars will hold value, trusting that the government has everything under control. But the people who understand how the system works, they're moving their wealth out of the banking system as fast as they can. Look at what's happening in commercial real estate. Office buildings in major cities are sitting empty. Companies have shifted to remote work, and they're not coming back. These buildings are worth a fraction of what they were valued at 3 years ago. And who owns most of that commercial real estate debt? Regional banks. The same banks that are supposed to be keeping your deposits safe. When those loans default, and they will, those banks are going to take massive losses. And when banks take losses, they either get bailed out by the government, which means money printing, or they fail, which means depositors lose money. Either way, you lose. Here's another angle most people aren't thinking about. Cybersecurity. Your money in a bank is just numbers in a computer system. And those systems are under constant attack. We've seen major breaches at financial institutions. We've seen ransomware attacks that shut down pipelines and hospitals and government agencies. What happens when a sophisticated attack targets the banking system itself? In 2016, hackers stole $81 million from the Bangladesh Central Bank by compromising the SWIFT system. They would have gotten away with $1 billion if a typo hadn't tipped off investigators. That's how vulnerable these systems are. Your wealth is protected by passwords and firewalls and the competence of IT departments. That's not exactly reassuring. Physical gold and silver don't have that vulnerability. They can't be hacked. They can't be frozen by a government order. They can't be seized through a computer system. They exist in physical reality, and whoever holds them owns them. That's real security. Now, let me address the counter-argument because I know what you're thinking. Gold doesn't pay interest. It doesn't generate cash flow. It just sits there. And that's true. But here's what gold does. It maintains purchasing power over time. An ounce of gold bought the same amount of goods 2,000 years ago as it does today. Can you say that about any currency? Can you say that about the dollar? The dollar has lost 98% of its purchasing power since the Federal Reserve was created in 1913. 98%. That's not inflation. That's systematic wealth confiscation, and it's accelerating. Think about what you could buy with $100 in 1970 versus what you can buy today. A new car cost $3,000. A house cost $25,000. College tuition was a few $100s per year. That same $100 today barely covers a week of groceries. That's the hidden tax of inflation. That's what happens when you trust the banking system with your wealth. And here's the thing about interest rates. Yes, banks are paying 4 or 5% right now. But that's because the Fed raised rates to fight inflation. And what happens when the economy slows down and they have to cut rates again? That interest disappears. You're back to earning nothing while inflation continues to erode your purchasing power. Gold doesn't have that problem. It's not dependent on central bank policy. It's not dependent on economic growth. It's a store of value that exists outside the financial system. And in times of crisis, that's exactly what you want. Let me tell you about 2008. When Lehman Brothers collapsed and the financial system froze, Gold was one of the few assets that held its value. Stocks crashed, real estate crashed, bonds became illiquid. But gold? Gold went from $800 an ounce to $1,900 an ounce over the next 3 years. People who held gold not only preserved their wealth, they grew it significantly, while everyone else was losing their shirts. And we're heading into a crisis that's going to make 2008 look like a warm-up. The debt levels are higher. The derivatives exposure is larger. The geopolitical tensions are worse. The currency system is more fragile. Every indicator that flashed red before 2008 is flashing red again, only brighter. Corporate debt is at record levels. Household debt is at record levels. Government debt is at record levels. And interest rates are higher than they've been in 20 years, which means the cost of servicing all that debt is exploding. Something has to break. It's not a question of if, it's a question of when. And when it breaks, where do you want your wealth? In a bank account that's subject to bail-ins and capital controls? In stocks that can drop 50% in a matter of weeks? In bonds that lose value when interest rates rise? Or in physical gold and silver that have been recognized as money for 5,000 years? Here's what a lot of people don't understand about precious metals. They're not an investment. They're insurance. You don't buy gold hoping it goes up. You buy gold hoping you never need it. But if the system does collapse, if currencies do fail, if banks do freeze accounts, you'll be incredibly grateful you have it. Think about it like this. If your house burns down, you don't make money from your homeowner's insurance. You just get made whole. That's what gold does. It preserves your wealth when everything else is falling apart. It's the ultimate insurance policy against monetary chaos. And right now, that insurance is cheap. Gold is still below its inflation-adjusted all-time high from 1980. If you adjust for inflation, gold would need to hit $3,000 an ounce just to match its previous peak. We're not even close to that yet. Which means there's still time to position yourself before the real move happens. Silver is even cheaper on a relative basis. At $85 per ounce of gold for every dollar of silver, we're near historic extremes. When that ratio reverts to the mean, silver is going to explode higher. We're talking about potential gains of 50 to 100% just from the ratio normalizing, before you even factor in the absolute price increase in gold. But here's the critical part. You need to own physical metal, not ETFs, not mining stocks, not futures contracts. Physical metal that you can hold in your hand or store in a secure vault that you control. Because when the crisis hits, paper promises are going to be worthless. We saw this in the 1930s. The government confiscated gold from American citizens through Executive Order 6102. They forced people to turn in their gold at $20 an ounce, then immediately revalued it to $35 an ounce. That's a 75% wealth transfer from citizens to the government. And it was completely legal. Could they do that again? Absolutely. In fact, it's easier now because most gold is held in ETFs and bank vaults where the government can access it with a keystroke. But if you hold physical gold in your personal possession or in a private vault outside the banking system, you're much harder to reach. That's why storage matters. You want your gold and silver in a jurisdiction that respects property rights. You want it in a facility that's not connected to the banking system. You want it insured and audited and accessible to you, not to some custodian who can freeze your account if the government tells them to. Switzerland used to be the gold standard for precious metal storage, but even they've become less reliable. They've signed information sharing agreements with the US and EU. They've frozen Russian assets. They're no longer the neutral safe haven they once were. Singapore is better. Dubai is better. Anywhere that's not fully integrated into the Western financial system. But honestly, for most people, the best option is to keep some gold and silver at home in a safe. Not all of it, because you don't want to put all your eggs in one basket. But enough that if the banking system freezes or the power goes out or there's a crisis, you have immediate access to real money that you can use. Because here's what happens in a real crisis. ATMs stop working. Credit cards get declined. Banks close their doors. We saw this in Greece in 2015. We saw it in Cyprus in 2013. We saw it in Argentina multiple times. When the system breaks, your digital wealth becomes inaccessible. But physical gold and silver, that's always accessible. That's always valuable. That's always money. And I'm not talking about some Mad Max scenario where society collapses and we're all bartering with silver coins. I'm talking about a financial crisis where the banking system freezes for a few weeks while they sort things out. That's happened multiple times in modern history. And during those periods, the people who had physical precious metals were able to function, while everyone else was locked out of their accounts. Think about what happened during COVID. The government shut down the economy overnight. Millions of people lost their jobs. Small businesses closed permanently. And the government's solution was to print trillions of dollars and hand it out. That money didn't come from nowhere. It came from the debasement of every dollar in existence. Your savings lost value to fund those stimulus checks. And we're going to see more of that. Much more. Because the government has no other tools left. They can't raise taxes enough to cover the deficit. They can't cut spending without causing a political crisis. So they're going to print. And print. And print. Until the currency loses so much value that the debt becomes manageable in nominal terms, but worthless in real terms. That's the end game. That's what always happens when governments accumulate too much debt. They inflate it away. And if you're holding that currency, you get inflated away with it. But if you're holding gold and silver, you preserve your purchasing power. You come out the other side with your wealth intact. Here's a specific example. In 1970, the median home price in the United States was $23,000. Gold was $35 an ounce. So you could buy a median home with about 650 ounces of gold. Today, the median home price is $400,000. Gold is $2,000 an ounce. You can still buy a median home with about 200 ounces of gold. Actually, gold has outperformed real estate over that period. But the point is, gold maintained its purchasing power. If you had saved $23,000 in cash in 1970, you'd still have $23,000 today. But that wouldn't even cover a down payment on a house. Your wealth would have been destroyed by inflation. Gold protected against that. And that's the key insight. Gold isn't about getting rich. It's about not getting poor. It's about maintaining your standard of living when the currency system fails. And make no mistake, the currency system is failing. It's failing in slow motion, but it's failing. Every time the Fed prints money, your dollars become worth less. Every time the government runs a deficit, your dollars become worth less. Every time a bank fails and gets bailed out, your dollars become worth less. This is a one-way street. There's no scenario where the dollar becomes stronger from here. The math doesn't work. So you have a choice. You can keep your wealth in the banking system and hope everything works out. Hope the government gets its fiscal house in order. Hope the Fed can engineer a soft landing. Hope the banks remain solvent. Hope the currency holds its value. That's a lot of hoping. Or you can take control of your financial future. You can move a portion of your wealth out of the banking system and into physical gold and silver. You can protect yourself against currency debasement and bank failures and government confiscation. You can ensure that no matter what happens to the financial system, you'll be okay. And here's the beautiful thing about gold and silver. They're liquid. You can sell them anytime you want. If I'm wrong and the banking system is fine and the dollar remains strong, you can convert your metals back to cash and you've lost nothing except maybe a small premium. But if I'm right and the system does collapse, you'll have preserved your wealth while everyone else is scrambling. That's an asymmetric bet. Limited downside, massive upside. And in a world where the financial system is this fragile, that's exactly the kind of bet you want to make. The safest place for your money isn't a bank. It's in physical gold and silver that you own outright, stored securely outside the financial system. That's how you protect your wealth. That's how you ensure your family's financial security. That's how you sleep at night knowing that no matter what happens, you're going to be okay. The question isn't whether you should own precious metals. The question is how much and how soon. Because every day you wait is another day your wealth is exposed to a system that's crumbling in real time. The smart money has already moved. Central banks have already moved. The ultra-wealthy have already moved. Now it's your turn.